Okay, so today we are doing a deep dive into the Berkshire Hathaway empire.
Hmm.
And this isn't just, a review of stock picks. We're really trying to dissect the Berkshire machine.
Exact.
The whole combination of strategy, culture, structure, all the stuff that created, really the greatest conglomerate success story in modern history.
It is, and we've been digging into everything. Warren Buffett's 2024 shareholder letter, the latest financials up through Q3 2025, and a ton of that academic research on where his performance really comes from. The stuff they call Buffett's alpha.
Right.
So our mission here is to kind of distill what made this 60-year run possible, and maybe more importantly, what it all means for the company's future now that this leadership transition is finally happening.
Okay, so let's start with the foundation, the culture, because
Yeah,
that feels like the one thing that's almost impossible for anyone else to copy.
it is.
This absolute insistence on like radical candor and accountability. I was reading the 2024 letter, and it's just so striking how openly Buffett talked about his mistakes. Most CEOs are, practically allergic to that.
Allergic is a good word for it. And what's really insightful is when you actually quantify it. We went back and looked at the letters from just 2019 to 2023.
Hmm.
He used the words mistake or error 16 times.
16.
Yeah.
Yeah.
I mean, you compare that to most Fortune 500 CEOs.
Mm.
A lot of them don't use either word once in 5 years. Buffett actually calls that kind of behavior nervous-making.
And he's so clear that the real sin isn't making the mistake in the first place. It's delaying the correction. He's always channeling Charlie Munger on this, right? The whole thing about avoiding thumb sucking.
Right. If you just wait for a problem to fix itself, it just gets bigger. And that culture, that honesty, it's really the bedrock for their whole succession plan.
Which is happening now.
Hmm. Greg Abel is set to take over from Buffett, who's 94, and he's supposed to start writing the annual letters himself at the end of 2025. This isn't some reactive move. It's the end of a plan that's been decades in the making.
But the plan is so much bigger than just picking the next guy. The sources really highlight the structure they put in place to protect the company itself.
You're talking about the voting trust.
Yeah, the transfer of Buffett's huge personal stake, what is it, over $150 billion?
Right, his 14% stake. And that detail is so important for any long-term shareholder. It's basically a permanent poison pill.
So no activist investor can come in after he's gone and just tear the whole thing apart for short-term gain.
Exactly. By putting that controlling block of shares into a trust that's governed by people who believe in the Berkshire Creed, they defend the whole legacy. It's an incredible defense of the structure.
It also points to this really unorthodox management philosophy they have. They prioritize character and innate business sense over a fancy degree.
Oh, absolutely.
Buffett says he never even looks at where a candidate went to school. He thinks business talent is just something you're born with. Nature swamping nurture.
Which is pretty radical in corporate America, where your pedigree can mean everything.
It's a nice idea, Hiring for brilliance over Harvard.
Mm.
But doesn't that reliance on gut feeling, doesn't it make the whole hiring process completely subjective and risky, especially when the founder isn't there to make the call anymore?
That's the challenge for sure. But the results, they speak for themselves. And they look for naturals who've already proven it over the long haul.
Like Pete Leigel.
Exactly. The founder of Forest River, still working his tail off when he passed away at 80 after creating billions in wealth.
The story about his compensation deal is just perfect. When Berkshire bought the company in 2005, he sets his own salary at $100,000.
Didn't want to make more than his boss.
Right. And his real incentive was a 10% bonus on any earnings above a certain number. That's just pure alignment and trust. No bureaucracy.
And you see it again and again. Ben Rosner, a guy Buffett called a retailing genius, never went past the 6th grade.
Wow.
These stories are meant to hammer home a lesson for you, the listener. They hire for character first. They believe that's more durable than any diploma.
And that focus on quality management brings us right to the big shift in their investing philosophy, which was, all Charlie Munger.
Absolutely. The move away from the strict Benjamin Graham cigar butt style of investing.
This is Munger's biggest legacy, isn't it? He's the one who convinced Buffett to stop buying fair businesses at wonderful prices.
And instead, focus on buying wonderful businesses purchased at fair prices. It sounds like a small change in wording, but it completely changed everything about how they allocated capital.
It shifted them from just finding temporary discounts to looking for businesses that could compound wealth for decades. And the research, that famous Buffett's Alpha paper, it really backs this up.
It does. It shows that their outperformance comes from combining quality and value, not just value alone.
Which sounds simple, but it must be incredibly hard to do.
Well, yeah. The researchers found the portfolio has these three characteristics that are woven together. It's safe, so low volatility, it's cheap, low price to book, and crucially, it's high quality
Meaning profitable, stable, growing.
and with a high payout ratio. So just finding a company that's trading below its liquidation value, the old Graham way,
Hmm.
that could be a trap. You need that quality, that stability, that great management to really compound over the long haul.
Which is why Buffett himself said it. It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price.
Precisely. And quality isn't just numbers on a spreadsheet. It's management that's honest and respects the minority shareholders.
Okay, so if management is the lord in the castle, let's talk about the castle's defenses, the fortress itself, the economic moat.
The economic moat, yeah. It's Buffett's most famous metaphor. It's just a sustainable competitive advantage that protects a company's profits.
Yeah.
It's a terrific economic castle from competitors.
So if you're trying to identify these moats, the research usually breaks them down into about 5 main types.
Right, the first one is just cost leadership. Think of Walmart's supply chain. It's so efficient they can just sell things for less than anyone else or keep higher margins.
The second would be brand strength or other intangibles. Coca-Cola is the classic example, right? That name gives them pricing power that's almost impossible to replicate.
Yep. Then you get into advantages that come from scale and market mechanics.
Like switching costs.
Exactly. It's just too expensive or too much of a pain for customers to switch to a competitor. And the fourth one, which is maybe the most powerful moat today, is network effects.
Where the product gets more valuable, the more people use it. Social media platforms, credit card networks.
And the last one is a technological edge, like Alphabet's search algorithm. Though the sources are always quick to point out that tech moats can be less durable than the others.
And durability is the magic word here.
It's everything. Buffett wants a moat that's going to last 5, 10, 20 years. The biggest red flag is a moat that depends entirely on the genius of the lord in the castle. If the advantage walks out the door when the founder retires, it wasn't a real moat.
And the genius of Berkshire is that the company itself is a fortress. Which brings us to their own structural advantages. Let's start with the big one. The power of float.
The float is the engine room. It's what makes the whole thing go. With their property and casualty insurance businesses, they collect all the premium payments up front.
The float.
Right, but they don't have to pay out the losses until much, much later, sometimes decades later.
So it's basically a giant pool of free money that they get to invest for themselves.
It's better than free. I mean, this float has grown from $46 billion 2 decades ago to $171 billion at the end of 2024. And it hit $176 billion by last September. This giant pool of capital acts as cheap leverage. The research we saw suggests it's cost Berkshire, on average, more than 3 percentage points less than just borrowing at the T-bill rate. No investment fund can match that.
And that leverage is protected by what they call permanent capital.
A normal mutual fund manager always has to worry about investors panicking and pulling their money out at the worst possible time.
Forcing them to sell good assets at low prices.
Exactly. But Berkshire is a listed company. Shareholders just sell their stock to each other. The company keeps the capital. That permanence let them ride out huge crises, like the 44% drop in their share price from 1998 to 2000. They could just sit and wait.
And that patience has led to just unbelievable scale. In 2024, operating earnings of $47.4 billion.
Aided by higher treasury yields and a huge turnaround at Geico. And the tax figures are just, they're hard to comprehend.
Yeah, that number blew my mind. In 2024, they paid a U.S. corporate income tax bill of $26.8 billion.
Billion. It's a staggering number.
Yeah. To put that in perspective for you, that one company paid about 5% of what all of corporate America paid in U.S. income tax last year.
And that's only possible because for 60 years, they just kept reinvesting. They only paid one cash dividend.
Yeah.
Ever. Back in 1967.
So what does this gigantic machine actually own now?
It's a mix. They have full control of 189 different businesses, some gems, some, disappointments. Plus they have minority stakes worth about $272 billion in places like Apple, Amex, and Coke.
But the preference is always the same.
Always. They'll forever deploy the majority of their money in equities. They want to own good businesses, not just sit on piles of cash.
Okay, but even with that track record, we have to talk about the mistakes. I mean, the whole Berkshire model demands they talk about their errors, and that gives us some really valuable lessons.
Right. So let's get into it. Lessons from the biggest mistakes.
And the first, most famous one was buying Berkshire Hathaway in the first place, the failing textile mill.
Yeah, Buffett called it a $200 billion blunder in opportunity cost.
And it wasn't even a rational business decision. It was pure emotion. He felt the seller shortchanged him on a deal, so he bought the whole company out of spite.
A temper tantrum that took him 2 decades and a ton of capital to unwind. Lesson 1. Leave emotion at the door.
Then there's the mistake of confusing growth with success. The U.S. Air deal in 1989.
He was attracted by the high revenue growth, but he learned a hard lesson.
That capital-intensive businesses, like airlines that always need new planes, can grow their revenue but just eat up all the capital. There's nothing left for shareholders.
He later said investors are often attracted by growth when they should have been repelled by it.
And for the importance of a durable moat, we have to talk about Dexter shoes.
The worst investment ever, he says. A $3.5 billion loss.
And what made it so much worse was that he paid for it with Berkshire stock.
Yeah, so the stock he gave away became insanely valuable, compounding the mistake over and over. He thought their competitive advantage, their low-cost structure, was durable.
But the moat just vanished. Globalization, outsourcing. It was gone in a few years. It's the perfect example of how even Warren Buffett can get crushed if the moat isn't permanent.
And finally, the big error of omission. Google.
This one is painful.
It really is. A classic case of staying too rigidly inside your circle of competence.
Yeah.
They owned Geico, which was a massive customer of Google advertising. He had a front-row seat to its incredible power.
But he just didn't make the effort to analyze it because it was outside his comfort zone. His view was that risk comes from not knowing what you're doing. And here he didn't do the work.
Exactly.
So let's bring this all back to you, the listener. The main lesson here seems to be that Berkshire's success, it's not some secret formula. It's built on these 2 pillars, structural advantages like the cheap float and permanent capital, and just this relentless discipline.
It's a philosophy of patience. You can contrast Buffett's style with someone like George Soros. Soros uses this high-risk global macro style that requires intense active trading. Very few people have the skill for that.
Whereas Buffett's advice is the opposite. Treat market volatility like a friend. It's a sale. The real risk isn't the market going down. It's buying something you don't truly understand.
Right. The Berkshire principles are designed so you can compound your wealth and still sleep well at night.
And that idea of integrity and long-term thinking leads us right to the final provocative question that all this research forces us to ask. We've established that the whole fortress strategy relies on 2 things: a durable economic moat and an honest lord in charge of the castle.
Right. Astute ethical capital allocation.
So with the leadership changing to Greg Abel, the big question for every investor has to be this: how do you actually assess if a new generation of leaders is going to be as fiercely committed to that same ethical long-term stewardship as the founders who built the whole thing? It is the ultimate test of whether a culture can truly be passed down.